guys, it's Chad Larson with MLD Wealth, and this is June 2025's episode of Money Matters. As mentioned, what we're here to do is to decode the latest market moves and economic trends and what they mean for you and your money. And thanks for tuning in. First, apologies. It's June 9th here. I'm sure this will get published in the next day or so. Apologies for the late start of the month. Last month I'd mentioned I'd be delayed as my wife and I were in Europe for a couple of weeks in a mix of business and pleasure. We were all over the place, zigzagging through Europe. Successful trip business-wise, and as well had some great moments with some old friends and some new friends. An exciting announcement, a little bit self-promotional. Over the weekend in Toronto, I was the recipient of the ICM Asset Management Award for Advisor of the Year in alternative investments. An incredible achievement. Very proud of myself. And I'm very grateful for this recognition and wanted to pass it on and highlight the achievement to you as clients and listeners abroad. The award truly belongs to my team and organization as they continue to support and foster a firm and an environment differently than the big banks to allow myself and my team to lead the industry and continue to bring institutional caliber investment management to high net worth individuals and families. Bit of a quick recap. I think I'll be, a little bit brief here. Obviously, lots happening, dominating the news. I'm not going to get into the TMZ style, component of Elon Musk's falling out with Trump. Leave that to the tabloids. But wanted to give a bit of a quick recap on global markets in May and early June. And before we dive into Canada's rate hold, let's look what happened over the past month. So U.S. markets, tech stocks continued to shine, driven by AI enthusiasm and NVIDIA's blockbuster earnings, but volatility crept in amid trade uncertainties. Lots going back and forth with respect to Trump's trade war, tariffs, and now the U.S. government is blocking them. And, it's still, this environment. And if you go back over the last 2 and 3 episodes of our podcast, that this is going to dominate, probably a large part of this administration, a ton of uncertainty. But we'll get to the punchline of what we're doing in and around that. Europe growth was mixed, inflation cooled slightly, and the ECB signaled potential rate adjustments later this year. In Asia, Chinese economic data disappointed despite stimulus efforts, while Japan's markets advanced on continued Bank of Japan support. Commodities, oil prices hovered in the mid-60s. US dollar barrel range with WTI around 64.60, Brent at 66.91 at the time of filming this, while gold remained elevated, trading just below 33.50, as a safe haven. So we continue to really like the gold trade. That exposure has been maintained and increased. It's been, really carrying its weight, across client portfolios. Currencies, the US dollar strengthened on a global risk-off sentiment, impacting Canadian exporters. Deep dive, let's talk about the Bank of Canada's rate hold. I understand that most people, especially the people listening, the Bank of Canada's interest rate is, may be impactful for your children or, mortgages and things like that. And try to make that connection as what does that mean? So, on June 4th, the Bank of Canada decided to hold its lending rate steady at 2.75. So this marks the second rate hold of 2025 after we saw cuts in January and March. So I want to unpack some of the key factors behind this decision. So some of the key takeaways, the lending rate influences the interest rate banks charge on financial products such as mortgages and loans. And, what does this all mean? Listen, in its decision to hold its lending rate, this is just a direct quote from the Bank of Canada on their website. It says, with uncertainty about U.S. tariffs still high, the Canadian economy softer, but not sharply weaker, and some unexpected firmness in recent inflation data, Governing Council decided to hold the policy rate as we gain more information on U.S. trade policy and its impacts. We will continue to assess the timing and strength of both the downward pressures on inflation for a weaker economy and the upward pressures on inflation from higher costs. So the hold signals the Bank of Canada isn't ready to cut rates just yet, as the economy grew more than expected in the first quarter of 2025, and core inflation has ticked higher. However, the Bank of Canada could cut its rate at some point this year. I am thinking, as I am pointing out, that the private sector has lost more than 70,000 jobs in the past 2 months. Still suffering from a little bit of jet lag. I was up early around 4:30 this morning. My wife and I were having coffee on the patio by 5. We started talking a little bit. So I guess isn't there what it's like to live with me? And she asked me kind of an interesting question: is two things trying to be true at the same time. The reality is as I've called it since the Canadian election, the Canadian economy is going to slip into a recession. It's trying to. It's weak. We can blame Trump, we can blame tariffs, but competitive edge, and productivity per unit cost of labor, has not kept up over the last 9 years. In the broader G7, Canada continues to slip, and while I'll blame government policy for all of that. We do have a bit of a significant problem, and why? Because GDP looks like it's growing, yet we're losing jobs. So this is a little bit of a tough topic. It's immigration. Think of it as water in a bucket. You keep pouring people in faster than the bucket, which is the job market. You're going to have a recipe for disaster. So I've got a picture here. It's from it's a quote from the Toronto Star. Unemployment rate rises to 7% in May as economy adds 8,800 jobs. Well, year to date, Canada has received 880,000 newcomers. And for this month, we added 8,800 jobs. So while the politicians will say we're growing the economy and we're growing jobs, that's true. But the other side of the equation doesn't match up. We're bringing in, we can't keep bringing in nearly 1 million people in 5 months while the economy creates just a fraction of the jobs needed. If immigration isn't tied to job vacancies, we're fueling a crisis. So this is a massive problem. We continue wherever your opinions lie, on Canada being a melting pot of him and nearly open borders. And, it was, I think, 2 years ago, very senior economist at National Bank published an article and it got massive media attention, basically made an analogy to the Canadian economy to, countries in Africa that have had, massive migration of populations into them and flooding the economy with people, causing massive unemployment. So we're letting in so many people. There's just no absolute way to keep up with jobs. Circling that back upwards, when my wife and I were talking this morning, and what would be a better way to fuel the economy? Listeners abroad kind of understand that the markets do well when the government cuts the interest rates because it fuels economic activity. It makes it cheaper to borrow money to invest in new businesses, and you name it. But with tariffs and kind of a slipping trade imbalances, inflation remains sticky. So if you cut rates while you have high inflation, you can put pressure, and we could fuel inflation. And the question was posed as, what would be a better way to stimulate the economy if just cutting rates keeps going back to zero? Because then the market has nowhere to go to fuel the economy, and that's what we had when we had very cheap money for so many years. It was a great way to do it. Cut taxes. It's a great way to stimulate the economy and create jobs. If you cut the personal income tax rate down, people would have more money, and saving rates would go up, and investment into new businesses and investments in savings and consumption would increase. But government policies still continue to think that they could do a better job shepherding and directing where your capital goes. And that's just the difference between conservative and liberal politics. An open economy with low taxation will create economic activity, will create job growth. The current administration and the government continues to think they can be a better do better with the use of proceeds, and I disagree. So listen, underlying inflation pressures have made the central bank's mission a little more complicated, but with the labor market showing signs of stress, we think there's room probably into the end of the year to deliver 2 more cuts. So what a rate hold could mean for Canadians. It's used as a benchmark by financial institutions to set the rates on mortgages, personal loans, and business. So when the Bank of Canada cuts its rate, it can become cheaper to borrow money, which I've discussed. And when it goes up, it can become more expensive. So all sounds so simple. When the Bank of Canada holds, there's not much change. For Canadians with both variable and fixed mortgages, things will just remain status quo. I still think there's going to be at least two cuts in 2025, but I'm just playing forecaster or weatherman at this point. I would say kind of consensus is probably other 25 basis points twice this year, but the exact timing of those, leave it to the bond traders to try to make money off the back of that. But the cumulative effect of 2024's interest rate cuts are starting to peter out a little bit, especially under the weight of the current economic uncertainty. So great. What are we doing about it? Positioning strategies. Made a big push internationally, and the quarterly trade rationales. It just went out, and there's we always produce kind of asset allocation strategies on a 1 month, 1 quarter in arrears basis. It's just the way timing works with financial reporting, etc. But we've been taking a proactive approach to navigating these market conditions. And one of the key areas we focus on is expanding our international equity exposure. And I'll talk to you why this matters. So why international equity? Valuation opportunities. Over the past decade, U.S. large cap tech has driven most of the market gains, leading to high valuations and concentration risks. Meanwhile, many international markets, especially in Europe and Asia, are trading at discounts, presenting compelling long-term entry points. Diversification benefits. Investing internationally reduces exposure to U.S. specific risks like political gridlock or regulatory uncertainty. With global economies recovering at different speeds, regional diversification helps smooth portfolio returns. Currency and monetary policy divergence. It's a lot of words, but the US dollar has shown signs of peaking, and a weaker dollar typically benefits international returns when converted back to CAD or USD. Different central bank policies, such as rate cuts in Europe and Asia, create potential tailwinds for non-US equities. And structural reforms and growth. Many international markets are undergoing governance improvements, infrastructure investments, and technology upgrades that position them for long-term growth. So shifting global trade, the reconfiguration of global supply chains due to geopolitical tensions, and the move towards nearshoring creates opportunities in these countries benefiting from these shifts. So how we're implementing these strategies, all of these get screened by compliance, so to speak, and I can't speak to specific strategies and specific SMAs and managers, etc. But I think what I think I'm going to promise to do for listeners is I'm just going to do a hosted podcast next month with the lead manager of a meaningful allocation that we've made across model portfolios. But it's looking for high conviction growth at a discount portfolios, targeting mid to large cap dividend paying equities outside of North America, focusing on quality companies in sectors like luxury goods, industrials, technology, and healthcare. A lot of the portfolios, are holding 15 to 30 carefully selected stocks that are diversified by sector and geography, and focusing on stable and growing dividends to provide reliable income and cushion volatility and currency hedge them back for Canadian investors. So, again, why now with valuations attractive, currency trends supportive, and international markets showing growth potential, we believe this is the right time to diversify and capitalize on those global opportunities. I always love a lot of this, if you can imagine, or maybe even believe, I don't have a team of podcast script writers. Many of you have known me over 20 years now. I do have a gift of the gab, and I'm quick on my feet. But this comes natural to me, being able to sit in front of a group of people, a single person or a microphone, and talk about the market. But even while I don't want to say I spitball this, but I do, and I think that's part of the goodness, or the reason we created this podcast was, this is how I talk. This is how I connect. This is how I think. And even while just spewing that last kind of thought out, I look back over a year ago, and I've made the conviction to why we remain constructive. The markets and equities in general has largely been on a synchronized global economic recovery. You've heard me pound the table on this for many years. Continued advancements of AI, making efficiencies, create better revenue flow, create better efficiencies across organization, and still trillions and trillions of dollars of cash on the sidelines from a high interest rate spike where a lot of money had left the market. So this is not new. This is not a pivot. We just took advantage of super high equity valuations in the US and have pivoted to add meaningful international exposure to large caps. So, what does this mean? Um, for investors and MLD clients, it's important to stay diversified, not just across asset classes, but across regions. Our push into international equities complements our private credit and alternative asset exposure. Our more valuation tilt into the US equal weighted markets. We're balancing risk and return by staying agile, investing in high quality global companies supported by strong dividends and growth prospects. At MLD Wealth, our focus remains on managing risk, seizing opportunities, and helping you navigate uncertain markets with confidence. To sum up, markets remain cautiously optimistic. That has been the one thing for over 10 years I've always said seems like the most give up of a thing for of an investment advisor to say. It's like you don't have an opinion. Cautiously optimistic. It's just uh, it's I don't know. I didn't poor in English class, but when two things are opposite of each other, but uncertainty does persist, especially with the trade tensions, inflation, and central bank moves. The Bank of Canada shows that they're in a wait and see mode, but opportunities remain, and we feel particularly internationally right now. If you want to discuss further how these strategies fit into your portfolio or explore how MLD can help you navigate this, I'm always here. The team is here on standby. We're here to guide you. I wanted to fold something in a non-salesy manner. I've built an incredible business, me and my team. We are one of the larger teams in the country, and we're recognized nationally and internationally. I was just invited to speak at an institutional conference next Wednesday in New York, sitting on a panel with some maybe 25-year-old Chad would have been super nervous to sit in front of. Was with the head of Citibank Private Client Group and a number of other massive institutions. They asked me to come and speak around positioning strategies of what high net worth, ultra high net worth investors are looking for, and how do we navigate the market. I've built a business that leads the industry because I care. I care about people, and I have a passion for investments. I connect well with people. I think I'm a great storyteller, but I think what I ask too in a non-salesy manner, this has been another period of high volatility and nervousness for investors with these tariffs with our southern border mates in the U.S. This feels like sometimes like an attack. If you're having friends and family and colleagues talk about this at the water cooler or at the dinner table or over beers, you feel free to pass on our names. If they're important to you, they're important to us. And so our door is always open. We've grown this practice to one of the largest in the country by word of mouth and by reputational capital. And it's something I'm so proud of. So listen, thanks again for joining me on MLD Money Matters. Stay smart, stay invested, stay tuned for next month's podcast. And like all things, I wish you and your families all the best. I'm here and the team is here. Feel free to reach out with any comments or questions. Have a nice month.